Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields. Kind of held the range today. Call yesterday we saw yields decline on bond buying and risks off, seeing equities come off, seeing commodities get crushed, emerging markets up in the air, and really it was a troublesome day for risk assets. For riskless assets, they did pretty good, and what we saw today was a bit of a bounce in risk assets, and the bond market just kind of shrugged its shoulders. We saw yields creep up a few basis points, but nothing that would signify a reversal of what we saw over the last couple of days. And I think ultimately implied volatility should be probably turning higher. It's really been trading sideways, which tells another story. The trend has been for lower volatility, no fear. You got a Fed in play that's going to raise rates slowly and surely. The only real risk here is growth and inflation not cooperating, and those two things seem to be cooperating right now with the Fed. Now, why volatility isn't going down at this point, I think, is more to do with the curve and the yield. The yield differentials between the 2 and 10 year and 5 and 30 year, it just continues to go flatter. Despite the modest steepenings that we'll see from time to time, the trend remains very flat, and that could be very troublesome as uncertainty into 2019 is not something that any Fed official wants, let alone as they want to continue to raise rates 2 to 3 times in 2019. And right now, that just isn't being priced into the market. We probably need to get through September rate hike and a December rate hike. Then we will start to see how 2019 might set up. But right now, it does not look like we're going to see an aggressive Fed if we take where current Fed fund prices are looking right now. And lastly, global risks are on the rise, and we see it in oil prices getting crushed. We see it in stock prices getting hit yesterday. Yes, there was a relief rally in stocks and oil stopped going down. However, the bond market just sort of, shrugged its shoulders, hasn't really made a big move higher or lower since that big move on Wednesday. And I think that ultimately, if you look at some of the credit markets around the world, whether you're looking at Italy, whether you're looking at what's going on in Turkey, whether you're looking at trade wars with China, whether you're looking at sanctions in Iran, there are rising risks out there, a lot of them financial and a lot of them geopolitical, and I think that the bond market is still waiting for clarity on all that, which is why when the 10-year note yield saw yields approach 3% not too long ago, we did not see it break through. We did not see yields get to 3.10 and make a new year-to-date high. We did not see continued bond selling. We saw the market get to a 3% yield and fail and reverse very quickly, and albeit on some fundamental news, but I think that right now the bond market is going to wait and see. The stocks can do what they're going to do. They bounced off that key level in the S&P 2800, but they rallied and they've been continuing to do so ever since. But I think in the bond market, it's smarter heads will prevail, calmer heads will prevail. And I think that ultimately a 10-year note yield trading south of 280 down to 275 is probably more higher odds than, say, seeing it rally back up to 3% at all. So at least heading into the September FOMC meeting, which isn't for about another month. So right now, 10-year note yield is still holding that macro range that we saw set about 2 months ago, between 280 and 3%. Yeah, I kind of look at 280 as kind of being a thin line in the sand. I like 275 as better resistance for the 10-year, but we'll call it 280 to 3%. But I ultimately think yields are going lower before they go higher again, but we may have to wait until either one of two things happens. We'll get to the September FOMC meeting, or the yield curve continues to trend lower to a point where it starts to invert, and then you might start to see some scrambling and shorts will cover, and things will change very quickly as 10-year yields approach 2 3/4. So right now, 10-year notes still holding that range at this point. We still have some data this week, and we will continue to watch that yield curve. This is Todd Colvin coming to you from the floor of the CME Group.